Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. Today's show, I'm going to call the Gold Show. Golden crosses, the golden rule, pure gold, golden moments, and golden opportunities. Plus your questions, and always to help me out, someone who is good as gold, my co-host, Mr. X, Twitter Tom. Hello, Thomas.
Hello, John. How are you?
I am happy that it is Friday, TGIF, right?
I've been waiting for the weekend, John. I think I need it. I need a good long sleep. That's what I need.
I don't know about you, but it's been brutally hot here in the Carolinas. One day I was looking at my the thermometer on my computer, and it just said, didn't give the temperature, just said it is really hot outside.
I like to walk about 5 miles a day, John. And the other day it was just so blistering hot that halfway through my walk, I gave serious thought to calling an Uber to come pick me up and take me home. Wasn't sure I can make it, John. All right. We got a jam-packed show, John. So before we jump in, I just want to give everybody a quick reminder. If you're watching on our website, you want to ask John a question, just click ask a question at the top right. You'll see it in the orange color. If you're watching on YouTube, go ahead and ask those questions directly in the chat. So, John, we got a little bit of exciting news this week. Stock market hit all-time highs. The Nasdaq was first, and what really caught my attention is the fact that it did one of my favorite things, John. It formed a golden cross for the first time since March of 2023. I guess the most exciting part here, John, is the last one worked out okay for us. It sent prices soaring about 82% over the next 23 months. I think all of us, John, would sign up for that again if we could get it. But the question is, John, is history going to repeat? Are we going to get something as exciting as what happened in 2023?
Well, I'm a CMT, chartered market technician, and we believe that technical analysis, particularly chart patterns, have value and predictive powers. But, the criticism is always that they can be kind of subjective and in the eye of the beholder. So, however, in patterns that have a sequence or an order, then that pattern has a lot more, that pattern recognition has a lot of more value. Now, again, you always get that disclaimer, right? History doesn't repeat, it rhymes. So, and the golden cross for, let's say, equities or like a stock, an individual stock, there's a lot of variables and conditions that could create that golden cross. But for indexes, what you're going to find is there's a very unique repeating sequence of golden crosses. So let's look at what's going on now, and then we're going to go look at a couple of that has happened in the past. So usually what happens is it starts or is preceded by our V bottom. You can kind of see, that rapid sell-off, and that V bottom drags the 50-day moving average, which is represented here by this blue line. It drags it below the 200-day moving average, and then the market rapidly returns, and then the 50-day moving average starts to move back up, which creates the crossover, the golden cross. Then after that, what you normally see is this more of a methodical rise in the market, right? Not, it doesn't go rapidly up. It kind of creeps up. We've kind of talked about this, bears take the elevator, bulls take the stairs kind of scenario, right? And then once it breaks through a high, it goes and breaks through a recent high. Now, usually it's an all-time high. And then from there, once after you confirm that breakout, what you usually see is that the market will draw back to that previous high before returning to that more classic bull rally, that staircase rally. And then what we learned 2 weeks ago about how you can measure the trough and that symmetrical targeting for a potential peak. Okay, so let's go back in history and look at a couple of more recent ones. Now, this one here, again, there's your V bottom, but we were already in a bear market, so to speak. And these are the kinds of ones that I like to set up. So I like to see in a stock particularly, right? Where your 50-day, comes below maybe a sideways 200-day. But in the indexes themselves, these are the ones you're going to find. Usually you're going to find an upsloping 200-day moving average. There's your V bottom. There's where we drive the 50-day below. And then again, notice what we see here. We see the market rallies up to the previous high, breaks out, then pulls back or draws back before moving on to that more methodical, rally. Again, let's look at a couple other ones. Here is another golden cross that came after a V bottom, right? There's the crossover. There is that more recent all-time high, breaks out, pulls back. This one actually had a deeper pullback. Now, if I go back into history a little bit more, let's get this out a little bit wide. Whoops. Let's make this nice and wide. Again, V bottom, crossover, test the all-time highs, break out above, return, methodical rally after. And you can go back and I can show you, of the last, I think Tom Lee told us that there was like 12 or 15 of them or something like that. And then if you go back and I think it was 80% of them are more classically like this. So from this point on, Thomas, what we got here is a momentum trade for the broader indexes. And I think there's 4 tailwinds that we can think about. One is asset managers are underweighted, and what they're doing now is they're trying to catch up. And you can throw in a little bit of retail FOMO there and algorithms front running the asset managers. You've got tariff resolution. We don't know exactly. I saw there's some news today, but it seems like we're getting closer to the end of that unknown, that uncertainty. Seasonality, we talked about this in the past, that July tends to be a very positive month for the markets. And then, I really think was kind of the catalyst of this whole movement now, is this belief that we're going to get 2 rate cuts in the near term.
Yeah, it's interesting, John, with the rate cuts. This is something I've been tracking for the longest time. And, there's times where the increase for a rate cut, John, but then eventually it just gets pushed back closer to the event. But this is interesting. So this is CME FedWatch. And currently, John, the market is pricing in about a 91% chance of at least a 25 bips interest rate cut by the September FOMC. And this is as high, John, as I can remember seeing this in quite some time. So it feels like the market is coming around to the idea that we're finally going to get that long overdue rate cut. What do you think?
Well, I think this is exactly what I'm kind of saying, is that the market is now pricing into rate cuts, and that's what is kind of got this drive in the market. But my concern more is this more of a buy the rumor, sell the news type scenario? And let me go to here to so here's our seasonality of the Nasdaq, and you can see July is one of the most positive green months over the last, what is this, we have 15 years. But notice September. No, September is not a positive month. It's actually a negative month, one of the few negative months we have on the calendar. So, as we get closer to September, you also we'll start another earnings season. And, what is a 0.25% going to do for the market, right? Is that going to make homeowner mortgages go down, or is that going to make borrowing costs that much more effective? I don't know. I don't think so. I think what we could be setting up for is a bit of a disappointment. But let's think about it again. And let's think about what they're talking about with the S&P or the Nasdaq, is if we can get a confirmation on this breakout. And one of the ways we can do a confirmation is what I've shown you guys in the past is you do a 2x or a 1.5x ATR, and you measure that, and then you need to get the price above that to do that confirmation. So for the Qs, It comes on around 553, and if you're playing it along with the Nasdaq, the number was 2255. I think we breached that just barely today, but I don't know if we got there. So again, I want to see that those levels breach, but I think in September, what we might see is, the realization of what the cuts mean, and then that drawback. So, I don't think this is a FOMO trade, Thomas. I think we wait for the confirmation, and then we look for that seasonality in September to get that buying opportunity, which, could be in somewhere in this pink box, down the line.
Yeah, and John, I think you asked a good question. What does 25 bips really mean? And I think at this point, John, what it really matters is on the psychological level. It's kind of a sign to the market, hey, we're going to start doing these cuts, and perhaps it will lead to a series of cuts. In fact, I saw a Morgan Stanley forecast. Now, again, trust these banks, for whatever you guys want. But Morgan Stanley says they expect 7 rate cuts, John, by the end of 2026. So
what would that be? If they did a quarter point on 7, that would be almost.
That would take us to about 2.75%, which would be below sort of that neutral level, John, where I think people would maybe start deploying some of their cash on the sidelines into risk assets.
Certainly in May, we might get a changeover in the Fed with a new chairman, and that chairman might be more dovish, right? For what the current administration wants. So that makes a little bit more sense. But again, you have to ask our question here is, why would the Fed cut rates? And this is the disappointment factor I'm thinking about, is why would the Fed cut rates if we're making all-time highs, if the economy is doing well, if, we've resolved the tariff issues, we're on the brink of world peace, right? I don't see that part of their mandate, the reason to cut rates. The only reason to cut rates is to help financing for treasuries. So yeah.
Yep. Well, and let's keep in mind the Fed has a dual mandate, right? They've got a dual mandate between inflation and unemployment. So if we're of the opinion, John, that tariffs aren't going to stoke inflation to the level maybe people thought a couple months ago, well, what's the other risk? Well, it's unemployment, right? It's people losing their jobs. So Powell has expressed concern about that, potentially the unemployment level creeping up to that 4.5% level, John. That would be problematic. So if the Fed has data, right, if they've got evidence that is on the horizon, they may want to get in front of that train and start cutting rates. So this could be, I know everybody's cheering for rate cuts, but this could be a bit of, be careful what you wish for. Moment,
yeah, right. I mean, exactly, because if we do see a significant rise in unemployment, is that going to be a good sign for the stock market? That is something that I think we can wait for a little bit later and ask that question at another time. But
to be determined.
Yeah, exactly.
All right, John, let's switch away from the equity markets and take a look at gold. Now, obviously, gold is an asset that has captured the imagination of many people. For the first time in my life, John, I actually own GLD. Never thought I'd see the day, but I do. But here's the problem, John. I don't own enough of it. I mean, I keep waiting, praying for another opportunity to load up on gold at a somewhat reasonable price. The market just is not giving me that opportunity, John, and I'm worried that my patience is going to run out, and maybe I'm going to do something I'm going to regret later on. So give me some good news.
I am going to give you a lot of good news on this one, because I did share this chart with you earlier in the week, right? This is a 30-minute time frame of gold. And what it looks to me is kind of like a head and shoulders. And really to me, a head and shoulders pattern is really a pattern of distribution where assets move from strong hands to weak hands. But you can see that the neckline here is at around 33.20. Now that's really a line of best fit. You could argue it could be a little lower, a little bit higher. So At the 30-minute time frame here, it certainly feels like the market is starting to break down a little bit, at least in this 30-minute time frame. But anytime we look at markets, we always say we have to look at from different lenses, different time frame lenses. So here's the daily, and let me change my template to a Bollinger Band, and you can see what's going on here is. We have now broken out on the lower end of the Bollinger Band. Again, that's a sign of the volatility is coming back into gold. And in this case, it looks like we're going to break out to the downside. Now, if we go to a weekly chart, and again, we leave our Bollinger Bands up, well, we can see that there is a mean reversion that looks like is coming, which puts us down somewhere, well, it looks like around $3,200, okay? So, Thomas, I think you're going to get your opportunity here. And if you think about what we just talked about, if the market, the broader market, is going to go higher. Now, in the past, I've talked about that I believe that there's a correlation between gold and the equities market, and that it has more times or not, it's a positive correlation than it is an inverse correlation. But there are times when the safe haven of gold, the capital flow out of it, is the catalyst of the S&P market. So I feel that this could be part of that process that we're going to see over the summertime. And if we look at gold again, what we see here, the black is gold, and the blue line is the S&P laid over it. That there is a real inverse correlation when the S&P breaks out of a recent high or making all new highs, that safe haven of gold is no longer needed, and that capital flows out of gold. And you can see it happened here, and here you can see the S&P broke out and gold went down. Here S&P broke out, gold went down, S&P broke out, gold went down, right? S&P broke out, gold went down. So where are we at now? Well, again, right? S&P is getting close to breaking out. Maybe gold will start trending sideways to a little bit lower. So let's go back to our 30-minute chart. And so let's look and see if we can find some levels of support. Let's go to a daily chart. Maybe it'll be a little bit better. Yeah, let's see, we're looking at gold here. So let's do a gold nearby chart. And again, remember when we do futures contracts, we always want to be contract specific, but we can get a kind of an idea. And there you go. We can see that there is some recent support around the 3180 level, which would correspond with our mean reversion on our weekly. But I do see a little bit more interesting level here around $3,000. And if we get a sustained rally in the equities market, Thomas, I think that is kind of somewhere where you could start thinking about buying your dip in gold.
Yeah, and that 3,000, that would be certainly a level I would love to get back in at, John. Maybe even a little bit below. I don't want to be too greedy, but that would be ideal, because I do think gold over the long term, let's say the next 5 to 10 years, I do think it's an asset that's going to do quite well. And a lot of people, especially young people, John, they might not think it's the most exciting asset in the world, but it's not about excitement, right? It's about trying to identify whether this asset is going to help your portfolio grow, and I think it will.
Well, after it has this little correction, it always seems to have this nice catch up, right? And if we believe that the stock market is going to go higher over the next 200 days or whatever was the last average move of the Golden Cross, then gold, yes, will catch up and eventually get back to making its new all-time highs as well.
Hey, John, for people who might not have any gold at the moment, what do you think is the best way for most people to play it? Is it just the GLD ETF, you think?
I think it's the easiest way to play the market. Yeah, I think. I mean, I'm always skeptical of actually owning physical gold. In other words, buying coins, because you might have to pay a premium for them, or a dealer handler. Gold miners, I think at some points can be advantageous, and depending on how they are relating to the market. Recently, gold miners have been underperforming while gold has been outperforming, but they've kind of been picking up. So there is times when you can play the miners. But I think overall, I think the best way for a retail trader or just a novice investor is through the GLD.
Okay. All right, John, let's switch gears. We're going to talk about, I think, an area, John, of the market that we haven't really covered in depth before, but I think its time has come, and that is uranium. And here's the reason why. Uranium stocks. Now, this is the ETF, URA. Uranium stocks are on track, John, for their 12th consecutive green week, their longest winning streak in history. And that is going to happen. I just checked the price. So it is going to be 12 straight green weeks. We've had a question or two on uranium in the past, John, perhaps during a period of weakness. Now it's obviously a period of strength. If people don't have uranium exposure, John, what are they to do here? Should they just kind of wait it out, or should they FOMO in here?
Well, Thomas, it's not just uranium. If you go to our investment page and you go to nuclear energy stocks, it's really the whole space, right? It's uranium and the nuclear stocks. But I think this is what this is more of just another iteration or another wave of the AI story, the power grab story. Of companies, for instance, look at the year to date on some of these stocks. So what I think is there are plenty of opportunities in here, but I really think what this is this bigger picture about how AI is going to be powered. And you've seen a lot of interesting deals, right? I think Microsoft with Constellation talking about restarting 3 Mile Island. They're talking about restarting a nuclear plant in Michigan. But it's the power that is for these centers. About a year ago, they were estimating that by 2030 that the power demand is going to go up to about 8 to 15%. But what is happening is that more of these centers are coming online, that the demand estimates have expanding exponentially. And right now, let me look at my notes here. It says that they're predicting that by 2030, the U.S. data center electric demand will reach 290 terawatts. Okay, so let me give you a perspective. And that's double what it was in 2022. And again, a year ago, they were saying it was only going to go up to about 8 to 10%. 1 terawatt equals the equivalency of the electricity consumed by 95 million homes. It's a huge amount of power. And so that's why nuclear now has to be the answer, right? Because we just don't have enough power to satisfy this urge, I guess you would say, of centers. And there was an interesting story that came out just this week, is that Texas now passed a law that says that power grids will now have the right or to disconnect data centers in terms of times of crisis. We just had a crisis event here on the East Coast with the weather. So this is really making them scramble even more. And that's what you're seeing with the nuclear story. These small modular nuclear power builders, OKOL and NuScale. Now, the problem is that there's been no licensing for any new small modular reactors from the Nuclear Regulatory, and there have been no U.S. patents. And these two companies are in the early stages of earnings, right? And they don't have any earnings. And their prototypes are probably not going to be until many years from now, probably 2027, 2028. So the feasibility or the bringing these to market is probably not going to happen until 2030. So there has to be some kind of stopgap. And that's why I've been so bullish on natural gas and those other power companies like Veranova, Vistra, what's some of the other ones that we looked at? Quanta, Mastic, Vertic. So all those different companies. But Thomas, I think this is not a story that's not going away. This is a mega trend story. and that there is going to be some trading opportunities in the nuclear space. I don't know which one is going to be the one that is going to do well. I just know that we can't get from point A, which is today, to point B when all these data centers come online without increasing the power supply.
Well, that's a great point, John. I like the story of uranium. The problem is, John, I don't know squadoosh about this area. I didn't even know what a terawatt meant. So, a lot of people, I think, rather than trying to pick winners and losers here, because for me, John, honestly, it'd be like throwing a dart at the board and just kind of praying. I think for a lot of people, the best way to play this is through the ETF that I've been tracking, which is URA, which gives you exposure to a lot of these names you just talked about, John.
Right. So here is their constituents. And again, when you talk about gold, which would be probably the best way to play gold, well, I think if you want to play the uranium space, again, remember, we've got this parabolic move in it. And, I don't think you need to rush it. This is a mega trend that's going to happen for the next, 5, 10, 15 years. But this ETF, if you want to play the uranium space, look at the 3 top asset allocations. You got a miner, you get the actual metal, uranium, and then the next 2 are those small modular reactor companies. So I think this is definitely one of the more easier ways to play this space until we kind of see how everything shakes out.
All right, John. Let's finish off the show, John, by talking about a stock that obviously everybody knows about, and that is Berkshire Hathaway. Warren Buffett, one of the greatest living legends the world has ever seen, John. He has outperformed the S&P 500 since, he started back in the 1960s by a huge margin. And because of that, Berkshire Hathaway is often traded at a premium. This is known as the Buffett Premium. You are investing in Berkshire Hathaway because you believe that Warren can continue to outperform the S&P 500. But John, that is fading. And, the S&P 500 and Berkshire Hathaway have traded in opposite directions since the early May meeting where Warren Buffett announced he was going to step down. So the Buffett Premium is gone. The market is now appears skeptical, John, whether Greg Abel can continue in Warren's footsteps. So, John, the question is, are you a buyer here of Berkshire Hathaway, or do you just want to stick with, make it easy on yourself and stick with the S&P 500 SPY ETF?
Well, first of all, I think this is a very fascinating chart, right? I mean, where do you see this kind of this breakout, fake out, and then this rapid reversal, right? Like you talk, the Buffett Premium looks like it's been sucked out of Berkshire Hathaway. But, Berkshire Hathaway is still the same basic company, regardless of that Buffett is there or not, or pulling the levers. And again, I don't know how they're breaking the responsibilities down. What I've understood is Abel is going to be more about a day-to-day kind of guy running the business of Berkshire Hathaway. And then there's a lot of other gentlemen or folks that are doing that actual stock selection and doing that valuation. So again, we don't know what's going to happen, but Charlie Munger, Buffett's partner, once said that if he can buy a quality company on its 200-day moving average, is where Berkshire Hathaway is right now, that he will outperform the S&P. And knowing that the S&P now is at all-time highs, again, look at this diversion, and this is what you were talking about. The S&P is at all-time highs, and I can buy a quasi ETF at a discount that, companies that are in the S&P 500 will sign me up all day for that, So I'm a buyer of this one. I haven't bought it yet, but I would definitely look to buy this. Now, if we look at this one, Thomas, and I'll give you just some food for thought here, is if you look at, let me turn off the S&P here for a second. Well, no, let's leave it on. If we look at when Berkshire Hathaway does dip below the 200-day moving, it usually corresponds with one of these V bottoms and then recoveries, or when we're in a bear market. And that is what we're not seeing, right? We're not in, we're post V market, and we're not in we're making new all-time highs. So again, I think that gives me more of an onus of why I think this is at buying a quality company at a discounted price.
Yeah, I like this from a trade perspective, John. Over the long term, just buying it and just, forgetting about it for the next 20, 30 years. I'm a bit more skeptical on that, John, because, I agree that Berkshire Hathaway has a ton of amazing talent and, analysts and people who are great researchers, but you still need a guy at the top, right? You need that final voice who's going to be able to sort of dismiss the bad ideas and go for the good ideas. Warren Buffett, one of the best ever to do it. He had that ability. Does Greg Abel have that same ability, or whoever's calling the final decision? Are they going to be able to replicate what Warren Buffett did? I'm of the opinion, John, that Warren Buffett, what he did is it's there's some science involved, but there's also some art. And
Some
I don't know.
talent,
I don't know that you can necessarily teach that. You can teach the strategies, but that final decision, I don't know that Greg Abel is going to have that ability.
Well, fair enough, but I think we both can agree that you are getting a company, in this case, really more like an ETF, at a huge discount compared to the broader market, right?
Agreed.
Okay, let's
All
leave
right.
it at that.
So John, I came across just a hilarious story. Could become problematic down the road. Fannie Mae and Freddie Mac, John, they're in the early stages of allowing people to secure home mortgages with
Yeah, I saw
cryptocurrency.
this.
So, John, there's a lot of people with huge bags of fart coin out there, and I'm imagining in my head them running off to their realtors trying to secure their first home purchase with their fart coin bags.
Or what's the other one? The dog one.
Dog goes to moon.
Yeah. So yeah, I mean, I don't know. This could be problematic for cryptos or for Freddie and Freddie. How are you going to value something that is very difficult to value, right? But maybe they just say that it's just Bitcoin, right? So
not your keys, not your house, John.
yeah, exactly. I think this is something that we need to keep an eye on, though.
Yeah.
And this might have, I don't know if this has a positive or a negative effect on the crypto space. Maybe we got to get our buddy Merlin in here to help us to figure that out, who's our crypto specialist.
I think Merlin is taking his crypto bags over to his realtor, John, right now.
I know he has a lot of crypto, that's for sure.
All right.
All right. Let's get some questions.
Ready for some Q&A. All right. Let me pull those up, see what we've got here. Here's a good one, John. What is the Bitcoin chart telling us? Do you think it's going to go to a new all-time high anytime soon?
Well, we talk about Bitcoin being more of an asset and a tech asset. I know that folks don't want to hear that. Bitcoin people don't want to hear that, but how it correlates with the Nasdaq. So I think if the Nasdaq moves higher, so will Bitcoin. That's kind of this risk-on environment. We had a guest about a month ago, Tom Lee, came in and said that typically Bitcoin leads the Nasdaq, and then Nasdaq catches up and then carries Bitcoin with it. So, to me, it's kind of trading sideways where the market is kind of making new highs. So I'm not bearish or bullish on this one. I'm just kind of waiting to see what is going to happen with this. Certainly, there's a lot of positive news in the crypto space besides your fart coin example there. But I don't know. What do you think on this one? I think it's kind of a wait and see time on this one, right?
Yeah, I mean, I do think the cycle is not over. I think Bitcoin is going to go to new all-time highs. I just think, John, it might happen later in the year. Like, we're kind of in the dog days of summer right now, and I feel like it could have a little bit of a slowdown in Bitcoin, and then it picks back up. Maybe September, maybe second half of September, maybe October, John, and then maybe goes into sort of a parabolic run to end the year.
Well, you've always said that you thought that you needed that catalyst of quantitative easing, which Fed cuts, to help motivate Bitcoin, right?
Right. So, and the market is now saying, right, that they expect that rate cut to come in September.
September, yeah.
Imagine a scenario, John, where they not only cut, but they end QT, right? And then that sort of corresponds with our idea of the 4-year cycle. You could have, that's kind of my case, my base case right now, John, is that all sort of unfolds at the same time, and then Bitcoin sort of goes nuts to finish out the year and finish out the cycle.
Right. I mean, it does kind of look a little bull flaggish, but again, right? It feels like it's kind of in a cycle of distribution right now. So
Yep.
Okay.
Let's see. Okay, this is a good question. Treasuries are not selling well, so rate cuts are out of the picture. Not quite. It's important to remember this, John. The Fed does not control the long end of the yield curve. They only control the short end. So when the Fed cuts interest rates, that is affecting the short end, right? So think of your checking account that might be paying you 4% right now. Those rates are going to come down. The long-term bonds, right? The 10-year, the 20 years, Powell has no control over that.
Right.
The market dictates what those are going to be.
Well, you'll definitely could see a steepening of the yield curve, which is more normal than when we say an inverted yield curve. But again, I think this is something we've talked about a lot in the past, is the issuance of treasuries, and that bond vigilantes might say, hey, if you're going to stimulate the economy or you're going to cut rates on the short end, that, I might want to have a higher yield on the long end. So, doesn't mean that long end rates are going to come down. Again, I still think like the 10-year note at some point will test 5%, but I wouldn't be surprised in the short run that we might see it, maybe dip down to 4%. But again, I just don't see how we can get the long end bond rate below 3.5%. When we're continuing adding to the deficit by $1 trillion or $2 trillion a year, and we still have to refinance another $22 million on top of it. So I'm going to stick with my guns in this one, buddy.
All right, John. John, do you think Bollinger Bands are useful on a 1 or 5 minute chart trying to scalp, as long as they stick with the trends on the higher time frame? Is that a good overall strategy to you?
Yeah, you're asking me something that I don't like. I don't like looking at those 1 and 5 minute time frames. I think there's a lot of noise down there. But, it is about probability and standard deviation. So if you're going to play Bollinger Bands in those micro time frames, then yes, I think if you only take those trades that are with your higher time frame trends, then that is a good tool that you can use. Again, the lowest I would go down now, and this is just in my age. When I was a day trader or a scalper, I was trading in the 5 minute time frames, but I do find that I think you get a lot of false positives and false negatives in those lower time frames. But yes, I would say if you're going to take trades in lower time frames, then only take those that are with your higher time frame trends. Yes, I think that's a good strategy.
John, do you find the weekly and or monthly pivot points useful in setting targets on the upside or identifying reversals on the downside?
I think it's both, right? I think, kind of my process when we look at the market, I look at weeklies and monthly, just kind of look at that range of price. Let's go back to Berkshire Hathaway. Right? If we look at this in the big picture on a weekly basis, and then get rid of the S&P for a second here, right? Where are we? Well, we're probably at the lower end of a range that we have. So is this a good area where I want to start being a buyer? Because my trend is still up. Yeah, I think that is. But if I'm going to take a trade, a momentum trade, or I'm going to take a risk reward type trade, then yeah, I got to set a goal. And so what could that goal be? Well, that's going to be in my former pivot high or recent highs. And what this does now for me is it tells me this is where I'm going to set my target. This is where I'm going to look for my entry. And then what I'll do is I'll look at those other time frames to look for structures or, trend analysis. But this kind of just gives me the playing field of probability where I think price is going to go.
I like this question. John, any thoughts on semiconductor stocks, mainly NVIDIA? NVIDIA just hit new all-time high. And actually today, John, it formed a golden cross. The last time it did that was Jan 2023, kind of in line with the overall market, but prices went up almost 700%, John, after that golden cross.
Let's ask this question. I mean, obviously it's a semiconductor company, but is it more than a semiconductor company at this point now? Does this stock represent, right, that disruptor, that stone that fell into the pond that creates the ripples of AI? And is it now advancing on other levels? Right? Has computing gone to like a new quantum level? So is NVIDIA just like maybe now is going to become, think about 10 years ago, we used to talk about as Apple goes, so does the market. And then I can go back in other time frames where other stocks have been the leaders. I mean, you can go all the way back where, US Steel or Ma Bell or whatever. But what I'm saying is, has NVIDIA evolved beyond the semiconductor space, and now it just represents, the whole AI idea, right?
I think it does. Yeah, I think it does. And full disclosure, guys, NVIDIA is my biggest position. So obviously I'm going to be bullish whenever I talk about NVIDIA, but I'm a believer, John, in this company over the long haul. I really am. I think they're a pioneer. I think Jensen Huang, it's kind of a bet on Jensen Huang too, who I think is just, an absolute genius, and he's got the right ideas. So I'm a big fan of NVIDIA.
Did it just take the most expensive or capital market?
It is the world's most valuable company now.
Yes.
Yep. And John, you were, semiconductors, you were looking at Avgo too, right? Broadcom. You kind of like that one.
Yeah, I kind of feel like the Mag 7 has kind of there's been a shift in the Mag 7s, where, I think if we look at the Mag 7, and maybe we can do a segment on this in the future. Yeah, I've added it to my Mag 7 in that Broadcom. Yeah, so that would be more like more of your classic semiconductor, right? And this is now a $1.2 trillion company. Is that right? I think it is, right? It is
1.2 trillion. I believe that's correct. Yeah.
Yeah. So, right, it's overtaking Tesla.
Yeah.
So, yeah.
Okay, John. Here. Okay, so we got person. He's looking for a good income play. He says he's pivoted away from the Mag 7 because he just feels like they're overstretched at the moment. So he wants your views, John. I guess pros, cons, your thoughts on whether you should go for an ETF like the Qs or maybe go for another ETF that has a higher dividend yield, which is kind of that income that this person is looking for. Any thoughts on that?
Yeah, I think if you're going to play the dividend yield or the income play, I think then there's a lot of other ETFs. And I'm not going to give any specific recommendations or examples, but you have to think about how much yield you want to get, and then a lot of times the company that you purchase, if you have a high yield, you might not get a lot of price appreciation. So there's kind of this balance between, do you want price appreciation in yield, or do you want yield over price appreciation? Now I'll give you an example that one of the stocks that is in my portfolio, Energy Transfer, is it in here? What's going on here? It's weird because you
can just put an ET, John. I think
no, it won't come up. If I do ET, we get the futures market. See, what is it? It's ET, but let me put it in. I think I have it in one of my other watch lists. But anyways, that one gets about a 7% yield, and that's in the natural gas space. But it's not going to give me a lot of price appreciation. I think it might give me some price appreciation, Here it is under. Here it is. Here it is. Okay. Right. It's kind of stuck in a range, but the stock gives me a nice 7% dividend, so that's a nice income yield, right? And I'm not worried about this company. I know it has a positive cash flow. It's in the right space. It's in that mega trend. And could this stock appreciate? I saw a deal that Williams did, which is a company that's in the same space, and their stock is doing really well. So is this a stock that could appreciate? I think it is. But I bought this stock because it's in the right space. I don't worry about their dividend, and because it has a high dividend yield.
And guys, just to let you know, John, we've got the best dividends page on the investing section. So if you guys are looking for an ETF that offers a really good dividend, you can go to that investing page, click the ETF tab, and you'll get the full list of all those ETFs.
Yeah, best dividends stocks, but then just go to the ETFs here.
Exactly.
Right. But there's that trade-off between price appreciation and the dividend yield. So you have to figure that out for yourself.
All right. So I think we got kind of a tongue-in-cheek question here, John, from a person asking, did Bitcoin correlate with the Nasdaq in 2010? And that was just after Bitcoin launched. So obviously, the correlation there is probably a bit off, right? Because the Bitcoin market cap was so small, John, that of course it went nuts, right, relative to the stock market. But I don't think we have data actually on 2010. That was the very early days of Bitcoin, John. But again, market cap was just so tiny at inception that it's really difficult to compare that to the broad stock market.
Yeah, and tongue in cheek back to you has Bitcoin evolved since 2010 when it was, way in the outer limits of investing, and now it's really become an institutional asset class, right?
Yeah, exactly. It's matured.
It certainly has.
Yeah. All right. I think, let's see. All right, we'll finish off with this question, John. With the dollar weakening, all right, we can all agree the dollar is extremely weak right now.
Mm-hmm.
Why isn't gold appreciating on that dollar weakness? Shouldn't it do that?
I agree. This is kind of my point, is that if the dollar weakens, that is definitely a positive for gold. And I've been kind of looking at where the dollar could go. And you're right, the gold price should go up. So there's even more evidence of what I was just talking to you about, is that capital is coming out of gold because now it's going back into the equity market or into other assets, maybe, not necessarily U.S. assets. Maybe we might see, going into, let's say, we talked about capital repatriation a couple of weeks ago. So, emerging markets have done really, really well. But yeah, I think the dollar has a lot more room to the downside. There you can see the kind of those black lines. That's kind of my target. And again, that could be supportive for gold. Why gold might not fall as far as what we had anticipated, because that is a positive for gold. But again, if gold is falling and dollar is falling, that is really a sign for you, right?
We got one final one. I just want to. They were asking about any stocks that are good swing trading candidates. What I would say, Malik, is just go to our YouTube channel, search for swing trading webinars. John has done a ton of swing trading webinars. It'll keep you busy all weekend. And
all summer long, like summer reading list, right?
The best way to find the good candidates for swing trading, I think, is just to sort of teach yourself and educate yourself on John's methodologies for finding those. Because I think swing trading, John, is one of your favorite sort of types of trading.
Yeah, but a lot of the screeners that I use are as jumping off points is bullish moving averages and standout stocks. Those ones have positive momentum, and those are usually good swing trading candidates. Okay.
All right. Malik says, thank you, John.
All right, great. All right, buddy.
One quick announcement, guys. Next week is the July 4th holiday. So John and I are wishing you guys a safe, guys, don't get too crazy with those fireworks. Okay. We want everybody safe and sound for our next show. So be careful, spend some time with the family, enjoy, and we will see you guys in 2 weeks.
You too, Thomas. You be safe too, and enjoy the week off. I know folks who have been on off summertime, but we'll get through the summer. We'll be a little bit more on a regular schedule basis. Until next time, thanks for being with us. I hope you guys got something out of today's show. Best of health, manage your risk, and the good of all trading.